This is your Wall Street wake-up call. Global stocks are higher as oil prices gain steam. With me now is Darryl Cronk, president of Wells Fargo Investment Institute. And Darryl, welcome back.
Thank you, Scott. Great to be here.
So, Darryl, oil prices are up this morning on reports that Russia's energy minister is in talks with Saudi Arabia on hopes of a possible production freeze. How important is oil for the stock market right now?
I think oil price stability is important for the stock market. So we need to see oil kind of stay in the upper 30s, lower to mid 40s, somewhere between, call it 35 and 50, probably is a good environment for the stock market. It's interesting because this quarter, Q3, will be the first quarter we start getting favorable rolling comps, comparables from a year-over-year basis on earnings. So energy earnings will stop being quite the drag they've been for quite some time relative to oil prices.
And energy companies are about 7% of the S&P 500,
yes.
So that's a big
down
deal.
From 15% back in mid-14, so they've really contracted significantly.
All right, now also with the markets, last Thursday we saw all three major indexes close at a record high. Now the last time we saw that was December 31st, 1999. Should we read anything into this, and are you worried about that?
No, it's natural for the indices to make new highs, albeit I would say the rally we've had, Scott, since the kind of mid-February lows of this year has been very ferocious. When you look at emerging markets are up about 19%, commodities are up 18%, high-yield bonds are up 17%. So even though it's been a great rally, even for U.S. stocks, we do think that it's probably time to start looking at with the VIX at a two-year low, putting in some volatility insurance as we move into the fall, because we still expect things to get choppy into the fall.
So volatility insurance to your portfolio?
Yes.
Okay, let's also talk about sort of the range that you expect in the S&P 500 going forward. Is it going to be this sort of narrow drift higher, or do we see a correction as we approach that August 24th, 2015 correction that we saw?
Yeah, so we're a year out from the big correction when China devalued the yuan last year. I would say it's been almost every 6 months we've experienced some type of 5 to 8, 5 to 10% correction. If you were going on that calendar basis, we'd be due. Although the data continues, the economic data continues to strengthen, so I would expect us to grind a little higher into the fall. We still think our midpoint on the S&P 500 for year-end is 2240, which is a little ways from here. But I would not expect it to happen in a straight line. I think we're going to get more choppiness. So again, if you look at the VIX at a two-year low, volatility this summer has been unbelievably low. And that's just not A, normal in the summer months, and B, probably what we expect heading into the fall.
And we've gone 3 minutes without mentioning the Federal Reserve. So before we let you go, let's get your take on when you think the next rate hike will be.
Well, the data, we're actually kind of in a sweet spot right now where the data is improving relatively, but not enough to make the Fed probably move to that next tightening basis, which I think is why you're seeing equities perform so well. We've been pretty cautious on the Fed this year, thinking the Fed would have very minimal, we said basically 0 to 1 raises all year. I still think that path and trend happens. It's ironic that the Federal Reserve now is probably the most hawkish major global central bank on the planet today when you consider it against the Bank of Japan, the Bank of England, the European Central Bank. So I would still say from the Fed standpoint, it's moved from kind of gradual to almost glacial movements in interest rate hikes.
But if we do see one more hike this year, does it come in September or December?
It would probably come in December. We need more data to give us that. We still think it's 0 for 2016, so we don't expect one in September and December at this point. Certainly the data could strengthen materially, but we saw GDP being relatively weak for Q1 and Q2. Certainly the jobs market has been strong, but you're going to need to see much stronger data to kind of get the Fed off a neutral here.
And of course we have an election this year, but that's a whole nother story.
Right.
Darryl Cronk from Wells Fargo Investment Institute, thank you for coming by.
Thank you, Scott.
I'm Scott Gamp, and you're watching The Street.